Let's dive deeper into the markets with Jordan Jackson. Jordan is a global market strategist at JPMorgan Asset Management. Jordan, good to see you this morning here. So futures or stocks out of the gate here, a little bit weak. Concerns about what's happening in China and the government's crackdown over there. Is it time for investors to be more cautious here in the U.S. because of what's happening in China?
Well, not necessarily. I think the path of least resistance for at least markets here in the U.S. is going to be higher. But I do think for now, the markets are sort of in cruise control. They're waiting for a catalyst to decide whether we should accelerate here or whether we should take a bit of a pause here. And I think the markets are sort of looking for China, potentially the Fed, to figure out what that catalyst might be. And I think right now we're hearing more noise than any sort of signals in terms of the trajectory for markets.
And Jordan, it's Julie here. What about earnings? How are you feeling about earnings thus far? Because I don't know if it's just me, but it feels like we're not sort of getting a clear theme from the companies that we've heard from thus far.
Well, I think what we're seeing from earnings is, well, first, earnings are delivering well above expectations. Roughly about 85% of companies are beating on expectations and by a healthy margin. But the challenge is, when I talked a little bit about that catalyst, markets have already been expecting this. They've been expecting a lot of this strong earnings growth. And so we're trying to see what will 2022 actually look like. And somewhat surprisingly, we've seen 2022 numbers continue to be moved up higher as well. And so I think these are all positive signs for the market to sort of hang its hat on. But, you know, it's a lot of diverging things. It's still that reflationary trade. We're seeing the strongest sectors, industrials, materials, seeing really, really strong growth in a year-over-year basis. Remember, second quarter of last year was a bit weak, so those year-over-year comps are a bit better. Slightly weaker on a quarter-over-quarter basis. But then when we look at some of the other sort of the more defensive sectors through the pandemic, sectors like technology and healthcare, they've been still signaling some pretty sturdy earnings growth as well. So I think there's a bit of a balance that investors will need to strike between, you know, putting their chips on the table with that reflation trade, which we still think has some legs to run, but also balancing that out with sort of the growthier side of the market as well.
And of course, Jordan, you know, tough to get too greedy about catalysts here with the S&P up, 18% so far this year or so. But let's talk about a potential maybe catalyst for the market. And that, of course, is the Federal Reserve. We'll get a comment from Jay Powell tomorrow afternoon. Then we have Jackson Hole in about 5 weeks. How are you guys thinking about the Fed's role as we get into the second half here?
Well, I think the Fed doesn't want to jump the gun here. You know, they know that if they start to talk about what the actual plan is to reduce asset purchases, it's going to be very, very hard to pull back. And there's still a lot of uncertainties around the lingering uncertainties around the pandemic and the developed Delta variant and how that's going to impact growth. We're still seeing some evidence of supply chain bottlenecks that could keep inflation running a bit hotter than anticipated. And so there's some risk that of a policy misstep on both ends of the aisle if the Fed sort of reacts or gives the market a little too much to go on too soon. So I don't think that we're going to get a lot any new news from the Fed tomorrow. I think they'll continue to tell us that they're talking about reducing the pace of asset purchases. They're talking about sort of what GDP is going to look like. Obviously, we get GDP on Thursday. And interestingly enough, some of those second quarter numbers have actually been ratcheted slightly lower, still very well above trend, but slightly lower. And so I still think there's a lot of question marks in terms of the stability of the recovery. I think the Fed is going to sort of, at least Jerome Powell is going to keep his bedside manner and try to keep markets a bit calm here.
But, Jordan, let me push back on that. Should we get some new news from the Fed tomorrow? We're getting talk of this earnings. Sherwin-Williams out this morning with earnings talking about sustained levels of inflation. Myles, in the morning brief newsletter, talked about more talk on earnings calls about high levels of inflation. Doesn't the Fed need to come out here and sound a little bit more forceful?
I don't think so, because I think what we're hearing about a lot of what these firms are talking about are simply a reflection of bottleneck issues, which many are anticipating to sort of work themselves out over the next 6 to 12 months or so. And so if this is going to be sort of a transitory inflation, I do think that this time next year, we're probably going to be looking at inflation running in between 2 and 2.5%. And I think the Fed sort of recognizes that as well. So I am sympathetic to the idea of inflation potentially running a bit hotter over the back half of this year. But I still think I'm more so in the Fed's camp that it's likely going to be a bit more transitory than sticky.
Fair enough. Jordan Jackson, Global Market Strategist at JPMorgan Asset Management. Good to see you this morning.
Thanks for having me.